What's going on, guys? Welcome back to the channel. My name is Matt. In this video, we're taking a look at the big banks' revised forecast for rate cuts over the next year and a half. And we're also going to take a look at the whole comparison of the variable and fixed mortgages right now. Which one looks more attractive? So first, if you've been keeping your eye on the news, you might have noticed that the big banks are suddenly changing their forecasts again. So a few videos ago, I talked about this where TD and CIBC, they had the most optimistic rate cut forecast at around 175 basis points. So let's break down what's changed. So what some banks are expecting is rates to drop even more than they initially thought from just a few days ago. Not too long ago, TD and CIBC were predicting that the Bank of Canada would cut interest rates by about 175 basis points by the end of 2025. But now they've actually upped that number to 2%, so 200 basis points, which would bring the overnight target rate down to 2.5%. To put that in perspective, the last time we saw rates that low was back in the fall of 2022. So you might be wondering, why are they changing their forecast again? Well, it lies in what's happened just a few days ago as well, with the whole global financial market kind of meltdown that we saw. So it's been a pretty wild ride lately, and I'm sure you all can agree. So let's start with Japan, okay? Recently, the Bank of Japan made a surprising move by raising its short-term policy rate to 0.25%. Okay, very unusual for the Bank of Japan to do this. This might not sound like a big change, but it's the highest it's been in 15 years. Okay, so before this, Japan had a long-standing negative interest rate policy. Okay, and the sudden change threw the global markets into a bit of a tailspin, as you probably heard on the news. So a quick breakdown of what happened. Okay, so investors who had borrowed Japanese yen at super low interest rates to invest that money elsewhere suddenly found themselves in a tricky situation. This led to what's called an unwinding of the yen carry trade. You've probably been hearing about that, the yen carry trade. What happened was it caused a sharp sell-off in Japanese stocks, but the effects didn't stop there. It actually spread to the rest of the global markets, causing a bit of turmoil worldwide. So what happened with this yen carry trade unwinding is directly affecting the other parts of the global markets. Meanwhile, over in the US, there's definitely growing concern that the Federal Reserve's high interest rates might push the economy into a recession. Recent data has been shaky. Weak job numbers and disappointing earnings from the big tech companies have only added to that uncertainty. People are starting to expect that the Fed actually might cut rates sooner rather than later to avoid a deeper economic downturn. And because Canada's financial markets are very closely tied into the US, we're definitely feeling the effects here too. So what does this mean for us in Canada? Well, this recent volatility has caused Canadian bond yields to drop to 2-year lows. This is significant because the bond yields often influence fixed mortgage rates, and when they drop, it usually leads to lower fixed rates. They're directly tied to it. And we've already seen some fixed rate cuts, and if these trends continue, we might see even more cuts coming in the coming months. But obviously that's not all. The Bank of Canada is growing more concerned about the economy's downside risks. In their latest meeting on July 24th, they discussed that they're now a lot more focused on the risk of the economy slowing down than inflation heating up. They're worried about things like consumer spending slowing down, especially as households will be renewing their mortgages at much higher rates in 2025 and 2026. Plus, with possible job losses starting to build up, there's a real concern that people will cut back on their spending, which could drag the economy down even further, right? If people spend less, that means people earn less, right? Because spending and income are very directly tied, okay? Or to put it maybe a little bit more accurately, companies' income falls, right? And then if companies' incomes fall and revenues fall, then they have to lay people off. They can't pay people as much. You know, they go bankrupt in a lot of cases, and that affects the economy. So one economist from Oxford Economics named Michael Davenport, he pointed out that these concerns might convince Bank of Canada that more rate cuts are necessary, even though we've already had a couple. He believes that we won't see a meaningful recovery in consumer spending until the second half of 2025. And until then, the rate cuts might be the only way to keep things on track. And that's honestly pretty concerning to read about. Now, not everyone agrees that slashing rates is the best thing to do, right? So we got Derek Holt from Scotiabank, he argues that while easing up on the rates might help balance things out, we need to be very careful. If we cut rates too quickly or too deeply, we risk bringing back inflation, and that creates a whole new set of problems, and that's definitely not something the bank wants to see. The economy is still showing a little bit of resilience, and inflation risks haven't gone away entirely, so it's important to tread carefully when it comes to all this kind of policy stuff. And honestly, I do believe that if Canada didn't bring in tons of people, like over 1 million people, and immigration numbers weren't so high, I think our economy would be in a much worse place, okay? So it's kind of been this like temporary band-aid on the economy. And so what's the main takeaway? So we're definitely in a big period of uncertainty. The big banks are responding by changing their forecasts. Now they're saying that we're going to get even more cuts, okay? If you're a homeowner or you're someone who's thinking about buying a home, these things affect you directly. They affect the mortgage rates, and it's definitely something to keep an eye on. Now let's talk about something else that's been on a lot of people's minds lately, the choice between fixed and variable mortgages, right? And this debate changes over time as these new economic developments happen as well. So with all the changes happening, the decision is getting a little bit trickier. So what's the deal with variable rate mortgages? We went from very low variable mortgages to very high variable mortgages. We're finally starting to see them come down this summer. And the Bank of Canada has cut its benchmark rate twice in a row now. Okay, so once in June and once in July. This has led the variable rates to start to dip. And there's talks that we could actually see more cuts before the year is out, especially given these economic challenges that are coming into place here in Canada and the United States. But even with these drops, the variable rate may not be the best choice for everyone, okay? So right now there's still a noticeable gap between the 5-year fixed rate and the 5-year variable rate. So if you're thinking about going variable, you need to believe that the bank will cut rates 3 more times in quick succession to make it really worth your while. So you're taking a bit of a risk, but if it does pan out, it'll be good for you. And obviously for many, sticking to like a normal fixed rate might just feel safer, even possibly a 3-year rate. And on the other hand, fixed rates have also been dipping as well. So mainly because the concerns about the US economy, as we were talking about, bond yields really starting to come down, especially now with all the global instability and a lot of stuff happening in the US with their economy, their election coming up. We're seeing some worrying signs south of the border, like the possibility of a recession. And if the US goes into recession, that'll not be good for Canada. We will definitely feel the effects of a US recession heavily here. Now, even though the Bank of Canada cut rates this year, so far totaling about 50 basis points, we probably won't kickstart any sort of housing boom, right? They're definitely catching people's attention. And I've definitely had more people inquiring about wondering if they should qualify for more, and now's the time to jump into the market. So it's sparking a bit of interest, but things are still quite unaffordable in terms of prices, in terms of interest rates. The affordability and the borrowing challenges are still very much here. Now, looking at the refinancing front, most people seem to be going for that 3-year fixed rate. That seems to be like that sweet spot for people. But there's a bit of a twist. There are some B lenders, okay? We call them B lenders. These are alternative lenders in the market that are offering very tempting variable rates right now, which may sway a lot of borrowers to consider a 3-year variable instead, which is really interesting. So in short, whether you go fixed or variable really depends on your situation, what you think the future holds with the rate cuts over the next 1.5 years, right? So we have a lot of stuff on the horizon, a lot of instability, a lot of question marks. And if you want to keep up to date with all of that information, make sure you subscribe. And if you guys like the video, really helps me push this information to a new audience who might really benefit from the information. And until the next video, guys, take care.